Hello guys, and welcome back to part 2 of our training. So in the first video we went over the settings and just talked about the few things we're really going to define going forward. Here we're going to look at the purpose of the fib and talk about the definition of it, what we can use it for really. And I want to get into the topic of market structure. So market structure, when we look at how the market moves, it can have a nature of moving in waves. Whether it's moving up, the type of nature that the market can really hold is something like this. This is called market structure. And that is when your market is making lows and making highs and making higher lows. This would be classified as more of an uptrend. And one of the number one things we can really use fib for is when the market's in an uptrend, or when the structure of a market is shifting from up to down. This would be an example of an uptrend market structure. It's classified as a market that's making higher lows and higher highs. Right? And the same opposite would be for a market that's going, say, in the downtrend. Market that's going in a downtrend has pullbacks in it. These pullbacks, when the market's moving like this and it's going 1, 2, 3, this from this point to this point is a pullback. Another word for it is a retracement. You're going to commonly hear me say that word retracement a lot throughout this video, and you may even hear other traders say that word or that term as well. So when market's performing this nature, what it's doing is it's pushing down and retracing, pushing down and retracing. This is the type of condition that we're really going to look at going forward in the videos, is a market that's doing something like this, where it's making highs, making lows, and making what's called a lower high and a lower low. A lower high, lower low. I'm going to show you how we utilize the Fibonacci in this type of nature or in this type of sequence with the market. And we're going to work up from there, guys. We're going to really work up from there. Now, two other things we're going to talk about is types of retracements. There's types of retracements. There is retracement number 1, which is called a shallow retracement. So let me just write this down out for you. So you have two types of retracements. You have a shallow and you have a deep retracement. Two types, and down here at the bottom I put a little side note for us to take a note off of for futuristic study purpose. Shallow retracements are more often to see on smaller time frames, or perform best on smaller time frames. Deep retracements are more often to see on higher time frames, and they perform best on smaller time frames and larger time frames, but they're more often to see on higher time frames. Take note of this, remember this. This is going to be a future note that is very, very valuable for you guys in this training. So again, deep retracements, they perform best on smaller and lower time frames. Shallow retracements don't perform best on higher time frames like your 4-hour, your daily, or your weekly. They perform best more on the 2-hour, 1-hour, or lower. So what is a retracement again? A retracement is a point when we see, let's just say the market's gone down and we've pulled back off of that first movement. That's a retracement. An extension would be when the market goes down, and we'll get more into that. But followed by this, that would be a retracement. So we use these percentages to find what I call stopping points in the market. Because every retracement has a point where it stops. And it goes down further. And it retraces more, and it stops. Every retracement has that stopping point. So what's been noticed over the decades, right, is that these stopping points, they fall within a percentage of this first movement. This is the first movement. The stopping points, they fall at a percentage here. They don't go right back up to the top. They may come about 70% of the way, 61% of the way, 78.6, or even these lower ones. So how we use the fib is we look at a market that's performing that structure, and we look for a retracement at percentages. We utilize these percentages kind of as an area where we're looking for a possible entry or as a possible stopping point. And if the market's continuing that structure, if the market's doing that again, right? If we see something like this, we see a high, we see a low, we see a lower high, and a lower low formed, and it's starting to pull back. What we do next is we take our fib from here to here. And we look for a possible retracement to one of these levels, and from there, we could look for that stopping point to create the next lower high. This is market structure again. If you guys look on your chart, you can find charts that move like this, that move in that wave. We're going to look at a few as we really go forward. Let me remove these. So again, we're going to be firstly looking at how we utilize these percentages and the difference between them. Because remember, shallow retracements, shallow, let me make this font bigger. Shallow retracements, they fall between 38 to 50% on the fib. Deep fall between 61.8 to 78% on the fib. So there's two really classifications of a retracement. And there's different ways to approach these retracements. That's really going to involve our time frames at the end of the day. That side note that we took at the beginning, put that back up. So deep retracements are more often to see on higher time frames. They perform best on both smaller and higher time frames. You can see them on both, but they're more often to see on those higher time frames. Shallow does not perform best on higher time frames. And remember, going forward, shallow retracements, those are more often to see on smaller time frames, like your 1 hour, 2 hour, or even lower. We're mainly going to be looking at the higher time frames going forward. It's going to end up looking something like this. What it's really going to look like when we go forward is something like this. This is a fib retracement right here, just drawn out. We're going to be looking at points where the market has started a run up, followed by a retracement that falls in between these percentages. That one right there should say 78.6, but on here it says 79. And I'm going to show you how you utilize this area as an entry zone. How you utilize these Fibonacci retracements to find an entry in the market or an entry zone. Same thing for if the market's going down. Kind of like I drew out. You have a market that's formed a high, has gone down, formed a low, and retraces off of that first movement. These percentages are going to be utilized for entries. Going forward, we'll talk more about zone of risk and target. Stay tuned for the other videos, guys. I will see you there. I hope this video was some help to understanding Fibonacci a little bit more. Take care.